Hello again, everybody. This is Ken Weber, president of Weber Asset Management. Today is April 22nd, 2021. Again, I'm here in New York, but today my friend and partner and chief investment strategist, Jack Bowers, is not in his normal spot in Reno. Jack, where are you?
Down in the Zephyr Cove area. I have some friends up in the area, and later this afternoon we're going to go on a little mountain hike.
Well, not everybody knows where Zephyr Cove is. That is
okay.
part of...
Not far from South Lake Tahoe. It's on the east side of Lake Tahoe.
Lake Tahoe, right. And you might be moving there in the not distant future.
That is a distinct possibility.
And as soon as we finish this, you're going on a 4-mile hike, I heard.
4-mile hike. Yeah.
All right, but that's not why people have tuned in.
Yeah.
Jack, markets have been kind of rocky the last few days. Mm-hmm. The S&P, as of today, is still up about 11%. It'll probably be up 10% by the end of today. After the great numbers that we booked in 2020, and we're still doing well 2021, people are getting nervous. Are we approaching a top? Is this a good time to invest? Talk to us about that for a moment.
Sure. I think we're kind of still in that nervous period because while the U.S. vaccination effort is going really well and the U.S. economy is getting back on track very quickly, the same is not happening in Latin America and Europe and other places. And so the global economy, which we depend on for exports, is still in a situation where there's a lot of uncertainty. I personally think that, as we approach, kind of full vaccination rates in the U.S., which we're very close to at this point, that the vaccine supply will then be available to other parts of the world, and Europe will probably get vaccinated pretty quickly, and even Latin America will start to receive more supply, India too. So I think the vaccinations, we've already seen how well they work in Israel, where they're close to 65% of the population vaccinated, and the cases have just plunged.
And they started to open up now a bit too.
Yeah, and they've started to open up, and they realize it can open up even with all the mutations. So the vaccines really are already proven as the solution here, and it's just a matter of time before we can get the whole world inoculated and get back to normal. So I understand why the market's nervous with the mutations and the surges in Latin America and India, but at the same time, I think we're well on our way toward a global recovery. It may be delayed a little bit. I don't think the nervousness in the stock market is anything to be too concerned about at this point. We've had a situation where growth stocks did really well last year. They are more or less fully valued at this point. And so I don't expect as much growth from the growth stocks going forward. It's really kind of a value stock game now, and we've moved our portfolios, kind of roughly 50-50, in some cases a little bit more biased toward value to take full advantage of the potential for value stocks. We're even making a select trade to get a little bit deeper into value on the value side, and I think that is still the right way to be. It will still be a good place to be for most of the year. And then as the economy goes back to normal completely, we can evaluate and look at the opportunities that exist and decide where we go from there. It might even be that we want to go back and add some international exposure at some point, because those stocks are likely to remain cheap until there's evidence of a clear recovery.
Let me just point out to some subscribers or followers who don't understand value versus growth. Value are stocks that are perceived as value compared to the rest of the market, as opposed to the growth area of the market where we had been overly weighted in the growth side, which tend to be the faster growing stocks and companies. So what Jack is saying there is that we're shifting away from the fast growing sprinters more to the marathoners, the value stocks. Is that a fair assessment, just as an explanation?
Yeah, value stocks tend to do well when inflation is rising and the economy is doing better. They tend to be by industry group, primarily financial, industrial, materials, energy, and utilities. Whereas the growth stocks tend to do well when interest rates are low, And in the pandemic situation, it actually, everybody's trying to do everything online. So, and there's a lot of investment in healthcare. So the growth industries are technology, healthcare, and consumer discretionary and communication services. And so really it kind of breaks down pretty cleanly by industry at this point. So we were heavily biased in the growth industries last year, and we've now added quite a bit of non-energy and non-utility value stock exposure to our portfolios since about August of last year. And now we're closer to a 50-50 mix of the two. And my view is, because of the increase in inflation, because of the increase in the economic growth rate, as everything goes back to normal, the value stocks really kind of have the odds in their favor, because a lot of them are still selling below where they were, pre-pandemic. So they still have recovery potential, whereas most of the growth stocks are selling quite a bit above where they were before the pandemic.
Yeah, let me tell you why I'm a little bit nervous, and it's sort of ironic because I've seen, I watch a lot of the TV financial people, and just recently, a day or two ago, somebody listed all the good things that are happening in the market. Interest rates are pretty low. Earnings are coming in strongly. The vaccinations are working out well. Basically, it's all check, check, check. Everything is on target, moving ahead in the right direction. Why does that make me nervous? Because when things are too good, money piles into the market. All the sort of scared money now says, okay, everything's good, I'm in the market. If something negative happens, they're all in already. They have no dry powder to keep the market up. And so that can become a problem. Mm-hmm. It's the kind of problem that's a good problem to have, but I just wonder what your thoughts are, that we're too optimistic now because everything, in fact, does look so good, so optimistic for the next 6 months or so.
That definitely describes the growth stocks. And because growth stocks are also very interest rate sensitive, if you have low interest rates, because the companies are growing and there's a lot of future earnings, when you discount that back to present terms, interest rates matter a lot to growth stocks, less so for value. And we've seen a huge surge in interest rates as things go back to pre-pandemic levels, and that has really weighed on the growth stocks this year. At the same time, they're posting good earnings. So a lot of people are taking profits and a lot of people are still jumping in. There's a lot of kind of beneath the surface churn with growth stocks right now. I don't think it's going to end up like the tech bust, because back then we were facing a huge earnings drought among the growth companies. This time around, the earnings are holding up just fine and actually still advancing at a pretty healthy clip. So, I think it's more a case where growth stocks are just going to become a little more volatile and maybe not grow as fast as they have for the last couple of years, and the action will shift toward the value stocks like it did in the first quarter and fourth quarter of last year. So I think what we'll see going forward will probably be a more pronounced shift, a less pronounced shift between growth and value, where things are starting to settle out as expectations converge. And so I think there is still some money on the table with value stocks. There's probably still a little even with growth stocks. I think if there's anything that kind of characterizes the rest of the year, it's just an environment rich with winners and losers. And so if you can focus on good stock pickers, there's a lot of opportunity.
Which we do. We do focus on the good stock pickers.
We've kind of de-emphasized index funds. We still have a few index positions this year, but in general, we're betting heavy on what we think are the best active managers.
Jack, let me throw you a question. I'm sure you're prepared for, but you and I have been partners now for 3 decades, basically. And we know that the bear markets, when they hit, there's nobody ringing a bell saying, now the bear market's about to start. What keeps you up at night? I mean, I've just described the incredibly optimistic and sunny days that appear to be ahead of us. But what are the scenarios? Because I could list 15. I'd like to hear from you. What are the unknowns that could happen that could send the market in the other direction?
I think the interest rate inflation thing is probably the thing that's looming out there as a threat that could do the most harm to growth stocks. Because even though we've cut back, we still have a substantial position in growth stocks. I personally think the Fed got it about right and Congress got it about right. I think we've done, enough kind of inflationary activities to bring the economy back nicely without too much damage. I really don't think we can afford to do a whole lot more stimulus without, having, some sort of income to, offset what we spend on the stimulus portion. So we definitely don't want to keep doing what we've been doing, but at least we've given the economy a fair shot at a strong recovery. And now with the vaccines rolling out, the timing is just right. So I think we've got it about right. If we get carried away with it, there could be more inflation, there could be higher interest rates. That would potentially set the stage for a growth stock correction or worse.
Ironically, that's one of my least fears, my least concrete fears, because one of the things that Donald Trump did right was Obama appointed Jay Powell to the Fed, and then Trump put him at the chairman's chair. And Jay Powell, when you watch him, when you listen to him, I have a lot of faith in him that he is going to do his best to keep interest rates low for as long as that makes sense. And he's indicated that could be for a year or two or three or longer. Time will tell. But so I think we are in a low interest rate environment, which obviously is going to be good for stocks unless other things happen. Right. Like another pandemic, like a few earnings reports coming in less than expected, like an attack on the electrical grid, that can't be fixed within an hour or two. I can go on and on. But with the market high, those things are happening. And that's why for our managed account clients, I try to sometimes temper excitement and say, no, we're not moving you up the risk ladder yet, because there's just the unknowns are out there. They are always out there.
So it's also worth pointing out the market has shown some sensitivity to the pandemic as well. There's still a lot of concerned investors that are worried that mutation or some new variant that gets out of control could, take us down for another run, and that could cause stocks to sell off as well. I'm a little less concerned about that scenario than the inflation interest rate scenario, for the simple reason that I think we're far enough along with the mRNA vaccines that we can outmaneuver the virus at this point. It's just a question of ramping up the supplies and getting, a first pass vaccination for all the countries in the world.
I agree. And the good news, of course, moving away from strictly investments, is that the technology that's been developed by Moderna and Pfizer and other firms, that's not going backwards. That's only moving forwards. Right. So that is permanent now, that we have new ways of addressing the problems of pandemics. And that is fantastic. The next pandemic is out there, whether it's this year or 100 years from now, it's out there somewhere. There are millions, literally millions of deadly pathogens out in the earth. And we don't know when the next bat is going to bite the next person.
Right. So, without the coronavirus, the mRNA technology may not have reached wide deployment for another 10 years. And so in a way, we have this huge advance in medicine that got forced on the system. And now that we've got it, it's great. There's potential to cure cancer. There's all kinds of things that can be done with mRNA vaccines now, not just protection against disease.
Yep. We always talk about bonds, bond funds. You sort of hinted at it with the talk about interest rates, but let's just talk about bonds for a moment.
Yeah. Recently, we're kind of barbelling, where we go with kind of really short maturity, high quality debt like mortgage securities and limited term bond, things that won't get hurt much with interest rates going up. And that's one end of the barbell. And the other end is high yield bonds, which have a decent yield, and they're more sensitive to the economy than interest rates. And that position has worked reasonably well, but I recently just broadened out on the high yield side rather than we had a lot of focused high income in some of the 70-30 portfolios. And I just replaced that with strategic income, which still has, I think, about 40 to 50% in high yield exposure, but it also includes longer term government debt and corporate securities, more of a broad bet. And I did that mainly because that, like stocks, there's a lot of winning and losing bets in bonds, and that particular fund, which operates in all segments and has multiple managers, I think is finding a lot of opportunities in a lot of places. It's done really well against its benchmark, and I think that makes a lot of sense right now, is to have a lot of places you can look for opportunities. So it's kind of a broadening of the interest rate bet. We're still pretty, or the bond bet, we're still pretty sensitive to what might happen with interest rates. So it's still a very kind of low risk portfolio intentionally, but I think there will be a chance to kind of broaden out. I think we've seen the worst of the interest rate surge because we're more or less back close to pre-pandemic levels.
I don't want to spend too much time in the weeds about bonds. And I just realized I have two more topics that people have been asking about before we run out of time. The first one, cryptocurrency. People are talking about it. There's a Coinbase just came on board as an IPO. There's ETFs that are actually out there already, or sort of closed-end funds. People are applying to open up mutual funds that do Bitcoin, other cryptocurrencies. Your thoughts?
It's, some people say it's a financial revolution. I'm not sure it's quite at that level. If you remember back in the 70s, when there was a lot of inflation and people buying and holding gold coins became a popular thing. The Krugerrands started it. And
this guy did that.
Yeah.
It's still sitting there, three Krugerrands sitting in my...
Did American Eagles. And yeah, so you could have had like an alternate economy where everybody transacted in gold coins because they were worried about inflation. But it was kind of, you had to go to exchanges, and most merchants didn't want the trouble of accepting gold and redeeming it and everything else. So, but now you can do that with Bitcoin, and it's all electronic and it's all automatic. And now exchanges are propping up online to make it easy. So we now have this kind of alternate currency that's like gold, a lot like gold. But it's a lot easier to transact in, and even though the transaction costs are high, much like they are with exchanging any currency, we're getting to see more and more companies jumping into it. Tesla, for example, is now accepting Bitcoin for car payments, which makes sense because high transaction costs don't matter so much for high value transactions.
Two things I want to point out. First, there's a high environmental cost. It takes a tremendous amount of electricity to run Bitcoin and all that, an unbelievably large amount. Second,
I drive my Tesla Model X 1,000 miles in the winter on the energy for a single Bitcoin transaction.
Yeah, it is.
But there is worth pointing out that it is carbon light compared with digging actual gold out of the ground. So if you think of Bitcoin as a replacement for physical gold, digital gold in essence, it is actually doing the world a favor from a planet standpoint.
But before we say too many nice things about Bitcoin, let's tell everybody listening, it's not an investment, it's a speculation.
Yeah, it's kind of a hard asset in my mind. Some people think it'll become a transactional currency, and it might, with Coinbase and others, helping to lower transaction costs by matching their own buyers and sellers. But gold historically has done maybe 1% better than inflation, and I think Bitcoin, because the supply isn't diluted as much, might do maybe 2 percentage points better than inflation. But I mean, these are kind of long-term run rates that are still inferior to stocks, which do 7 percentage points better than inflation. The only reason they've done well is because they went from being an obscure asset class to being on par with gold in a very short period of time. So there was a massive amount of appreciation to get there. But now that Bitcoin is on par with gold from a market cap standpoint, or I should say on par with private ownership of gold, we're at least at the point where the long-term run rate is now kind of imposed, and it's not going to be going up in the future, anything like it went up in the past. So I just don't think there's much value to including it in the portfolio. We've never had much gold in our portfolios. We've sometimes had gold mining stocks, but only at very, short intervals. And I think Bitcoin's the same way. You don't really need it in your portfolio to do well. It doesn't do anything to reduce risk, really. So people who like to speculate it, I recently wrote in Fidelity Monitor and Insight that, a 1% bet is certainly, okay. You know, it's not going to do you any
Right.
damage in the long run.
Small
But
investment.
I don't really see a role for Bitcoin in our client portfolios.
You just mentioned the newsletter, Fidelity Monitor and Insight.
Mhm.
The last thing I want to talk about today is clients sometimes ask us, or prospective clients ask us, the difference between having money managed at Weber Asset Management, or, money management versus following along by themselves in the newsletter. We have lots of reasons we give why it's really much better to have professionals helping you along, but I'd love to hear your thoughts about a newsletter versus true money management, hands-on money management.
Yeah, on the newsletter side, it's kind of a team, and we're making group decisions. And in my experience, it oftentimes takes longer to arrive at what you might otherwise do. On the money management side, it's a more streamlined investment process where I'm mainly proposing a change, and if it meets muster, then we go ahead and make it in a very relatively quick response fashion.
Right.
An example this year, for example, in the unique opportunities portfolio of the newsletter, John Bonanzio and John Boyd were more comfortable with international capital appreciation than I was, and so we hung on to that longer on the newsletter side. Whereas on the money management side, I jumped into low price stock for international exposure, and the portfolio is better off because of it. So other times, like the select model, for example, we haven't had any major differences in holdings, but we do move earlier than the newsletter, typically several business days. We'll move the managed accounts in first, and then
Managed accounts
trades
go in first.
because newsletter clients expect our trades to be near the end of the month, and they don't really want to keep track of mid-month trades or early month trades. So we tend to not do things on a time schedule that would make it difficult for people to follow in the newsletter. Whereas on the money manager side, it's us making the trades. We can do it whenever we want.
Whenever it's appropriate. Perfect. There's lots of other reasons why I think it's better to have a true money management than doing it on your own. But if you want to do it on your own, Fidelity Monitor and Insight is a great newsletter. And I have no problem if people are sure that they want to do it that way. Jack, we've run out of time. Again, thank you. Have a wonderful hike. Stay healthy. Watch where you step. To everybody at home, make sure you get your shots, and we'll see you next time. Thank you all.
Okay. Bye-bye.
Bye.